A common misunderstanding in business is, if revenue is growing, the company must be doing well. But high revenue does not automatically mean high profit. A company can generate $5 million, $10 million, or even $100 million in sales and still lose money. Why? Because revenue tells us how much the company sells. Profit tells us how much the company actually keeps. Today, we are going to understand why a company can have strong sales but still struggle to make money. Imagine a company generates revenue, $1 million. That sounds impressive. But now look at its expenses. Cost of products or services, $550,000. Payroll, $250,000. Rent and office expenses, $70,000. Marketing, $80,000. Insurance, software, and professional fees, $40,000. Interest and other expenses, $30,000. Total expenses, $1,020,000. The company generated $1 million in revenue, but it actually lost $20,000. This is why management should never look only at revenue. The better question is, how much profit are we generating from every dollar of revenue? The first reason is a low gross profit margin. Suppose a company sells a service for $100, but it costs the company $85 to provide that service. The company keeps only $15 before paying management salaries, rent, marketing, accounting, insurance, technology, and administrative expenses. That $15 may not be enough. For example, revenue, $2 million. Direct costs, $1,700,000. Gross profit, $300,000. Gross margin is only 15%. Even though $2 million in revenue sounds strong, the company has only $300,000 available to cover the rest of its operating expenses. Another common problem is excessive overhead. As companies grow, management may hire more employees, lease larger offices, purchase more software, add management layers, and increase administrative spending. Before growth, revenue, $500,000. Overhead, $150,000. After growth, revenue, $1 million. Overhead, $450,000. Revenue doubled, but overhead tripled. The company became larger without becoming more efficient. This is why management should monitor revenue growth versus expense growth. If expenses are growing faster than revenue, profitability will eventually suffer. Companies sometimes increase revenue by offering very low prices. Sales go up, customers are happy, but the company may be losing money on every transaction. Imagine a security company charges a client $30 per guard hour. But the real cost is guard wages, $22, payroll taxes, $3, workers' compensation, $2, insurance and benefits, $1, scheduling and administrative cost, $2, supervisor cost, $1, total cost, $31 per hour. The company is charging $30 for something that costs $31. The more business it wins, the more money it loses. This is sometimes called growing yourself into a loss. Management must understand the true cost to serve each customer before setting prices. Not every customer is equally profitable. One client may generate $100,000 of revenue with very little management effort. Another client may also generate $100,000 but constantly requires customer service, rework, special reporting, discounts, rush orders, management involvement, and additional employees. The revenue looks the same. The profitability does not. This is why companies should perform customer profitability analysis. Ask, which customers generate the most revenue? But also ask, which customers generate the most profit? Those are two completely different questions. For service companies, payroll is often one of the largest expenses. Suppose the company has 20 employees. Revenue is increasing, so management hires another 10 employees. But the workload could actually have been handled by improving processes, automation, SOPs, technology, and employee productivity. Instead of becoming more efficient, the company simply adds people. Revenue may increase 20%, but payroll increases 40%. Profit disappears. This is why management should track metrics such as revenue per employee and labor cost as a percentage of revenue. Here is another important concept. Profit and cash flow are not the same thing. Imagine a company completes $500,000 of work this month. The income statement recognizes $500,000 revenue, but customers have 60-day payment terms. The company has not received the cash yet. Meanwhile, the company still needs to pay employees, vendors, rent, insurance, and taxes. So the company may appear profitable on paper, but still have very little cash in the bank. This is especially dangerous for rapidly growing companies. The faster they grow, the more working capital they may need. Another problem is financing cost. A company may have strong operating performance but carry too much debt. For example, operating profit, $300,000, but interest expense, $220,000. After interest, only $80,000 remains before taxes and other expenses. Debt can help a company grow, but excessive debt can consume the company's profits. Management should monitor interest expense, debt payments, debt-to-equity ratio, and debt service coverage. Small expenses can become large problems when nobody is monitoring them. For example, a company may be paying for duplicate software subscriptions, unused vendors, excess overtime, expensive consultants, unnecessary travel, excess inventory, and poor purchasing contracts. Individually, each expense may look small. Together, they can destroy profitability. This is why companies need budgets, variance analysis, approval controls, and regular financial reviews. Revenue mix matters. Imagine a company has two services. Service A, revenue, $500,000. Profit margin, 40%. Profit, $200,000. Service B, revenue, $1,500,000. Profit margin, 5%. Profit, $75,000. Service B generates 3 times more revenue, but Service A generates almost 3 times more profit. This is why management should not simply ask, how can we increase sales? A better question is, which products, services, and customers should we grow? Sometimes the biggest problem is not sales. It is that management is operating without a financial strategy. The company may not have a budget, a cash flow forecast, break-even analysis, profitability targets, pricing analysis, department budgets, or financial KPIs. Without these tools, management often discovers financial problems only after the money is already gone. Every business should understand its break-even point. For example, fixed operating expenses, $500,000, gross margin, 25%. To cover $500,000 of fixed expenses, the company needs $2 million of revenue just to break even. So if the company generates $1.8 million in revenue, management may think, we almost made $2 million. Finance sees something different. We still have not reached break-even. That difference in perspective is extremely important. Instead of looking only at revenue, management should monitor several financial indicators: revenue growth, gross profit margin, operating expenses, operating profit, net profit margin, cash flow, and accounts receivable. Break-even point, customer profitability, revenue per employee, and budget versus actual results. Together, these numbers tell management whether the company is actually creating economic value. Consider 2 companies. Company A, revenue, $10 million, net profit, $100,000, net margin, 1%. Company B, revenue, $3 million, net profit, $450,000. Net margin, 15%. Which company is financially stronger? Many people may initially choose Company A because it has more revenue. But Company B is converting its sales into profit much more effectively. This demonstrates an important financial principle. The goal of a business is not simply to generate revenue. The goal is to generate profitable and sustainable revenue. When a company has high revenue but cannot make money, the problem usually comes from one or more of these areas: low margins, high overhead, poor pricing, inefficient operations, weak cost control, cash flow problems, and poor financial planning. Revenue tells you how big the business is. Profitability tells you how healthy the business is. And cash flow tells you whether the business can survive. A financially strong company should therefore focus not only on how can we sell more, but also how can we make every dollar of revenue more profitable. That is the difference between growing a business and building a financially sustainable business.